All right, all right. Good morning, good morning. How are you guys today? It's a beautiful day here in the Cache Valley. I think that's a great name for a place to live, don't you? I live in Cache Valley, spelled C-A-C-H-E. All right, let's get started. First thing I want to do is I got some exciting things to show you today. We're going to go through and we're going to just have a kind of an easy day on this one because we're just going to review the stocks that we have. We're then going to go and look at some defensive positions, and I've updated the calculator, so we've got some new calculations in there, and I put the granite stone things into our calculator so we can see how they compare. And pretty much we're just going to review the stocks we've got, see if there's not some new ones coming up. We'll go over and look at the bubble scanner, go visit Little Bubbles and see how she's doing, and we'll get started right now. Let's do that. The first thing I want to do is I want to go and I want to look at SHY. So pull up SHY in your computer and let's go look at it together. All right. Because SHY is the 1 to 3 year treasury bond. And when bonds go up, stocks go down, bonds go up. That's generally the rule of thumb. Now, it doesn't always happen like that. Sometimes, as we talked about last week in class, over that long, big uptrend in the stock market, the bonds went up with it. So that's a little strange, but doesn't mean it can't happen. Certainly does. But on a shorter term basis, markets have a tendency to be a little bit sensitive to the bond prices, especially the 1 to 3 year treasury bond, because, you know, the whole idea is that if it gets more expensive to borrow money, it gets more expensive to produce a company's output, because they generally run on credit, right? They borrow money and then they grow and prosper and create more jobs and do all that neat stuff. They do it all on credit. So if credit gets expensive, it's hard to do that, and so it hurts the economy to have high interest rates. Now, it also, there's the flip side to that, and we mentioned that in class last time. Flip side to that is that if we're people who have a bunch of money that we're living off of, we want high interest rates, right? Because we want to be able to receive that money. So it goes both sides. Interest rates are bad in one way, high interest rates are bad in one way, but they're good in another way. So you have to always take the both sides of the story. Don't always just myopically focus on one side of the story. If you're a stock trader and you're looking for big growth in your stock, then yeah, you want interest rates to go down. But if you're a long-term investor holding on to bonds or CDs or very safe places to put your money, which generally is an interest rate style investment, you want your interest rates to go up. And so, there's got to be a happy medium, got to be a balance in there. Interest rates were, down around zero for years and years and years. I remember when I was young man buying my first house and interest rates were 12%. And we thought, well, if I could get less than 12%, I'd be really happy. My first house, I think, was right around 10.5% or something, was the first house I ever bought. And we were just like so excited because we were able to get less than 12% on our interest. So, you have to also take into past, kids nowadays want to go out and buy houses. And granted, the price of houses are outrageous and wages haven't really kept up with those prices of houses. It's making it really tough. I got two boys, both of them, one's got a house, one doesn't. And he would like to have a house. And he's like, well, maybe I'll just end up renting my whole life, Dad. Houses are just outrageous. Can't afford, and then of course there was the rule that, you could afford a $2,000-$3,000 rent payment, and you'd go into the bank and say, well, I want to buy a house. Well, you don't have enough money to buy a house. You can't prove that you can make the payments. It's like, I'm making $2,000-$3,000 a month payments now on my rent, but I can't afford a $1,500 house payment. Nope, you don't qualify. But I think that they've been actually trying to pass a law in Congress. I don't know if it passed or not, if it's gone to the president's desk, if he signed that or not. But they're supposed to make that easier for people. If you can prove that, you've been paying rent for $2,000 a month for 10 years, you should be able to qualify and use that as a qualification for your home. Say, well, I can certainly afford a $2,000 house payment if I can afford $2,000 in rent. So I think they're trying to make that easier on kids, but still, nonetheless, houses are getting outrageously expensive. I mean, I bought this house that I'm in for $210,000 when I bought it, and my neighbor said that, I mean, they just sold their house for over $500,000, $500,000. My house way nicer than theirs. I can't believe that my house is worth $500,000. To me, that's just outrageous. That this little house that I lived in for 25 years is worth that much money. It's just ridiculous. I love my little house. It's beautiful, and we keep it up and take care of it, redecorate it, and remodeled it. And it's a really nice little house, but I can't believe it's worth over $1 million, over $500,000. Just crazy to me. And so, that's just the way it is. Things are getting more expensive, and unfortunately for the young kids, prices aren't going up, or their wages aren't going up that much either. I got my one son, an engineer, physics and chemistry engineer is what he come out of school with, and he's working really hard and got a great job and doesn't make, you think $100,000 is a lot of money. He's not making that, and I look at him and how he's living, and he's doing really well, way better than he thinks he is. That's for sure. But even with a, $75,000 a year job, he, still struggles a little bit. So I don't know. Was it easier for us as kids? Because that's what they always say. Oh, you had it easy when you were kids. 12%, interest rates on our homes, and our homes were, granted they were only, paid $200,000 or $150,000 for a home. I think we paid $175,000 for our first home. $150,000 for our first home with a 12%, 10% interest rate. I don't know. I was only making. What were you making in when you worked? I mean, minimum wage was like $5.50, $6 an hour, or something like that. So I don't know, but minimum wage is still $7 an hour. But I don't know. I don't know any of that stuff. It's hard to know. Feel bad for kids. The economy's tough. That's why this is so important, what we're doing here in these classes. And that's why I think it's important that we learn how to help produce money in another way. I think that a second source of income, multiple sources of income is the way you're going to have to live your life. The days of just having a job and going and working at the gas station, pumping gas and making that be enough money to live off of, those days are over. I don't think you can live off of that kind of money anymore and have any kind of a, a really tough life that way. But young kids are nimble and young and excited and ready to go. I don't know. I just have my boys and I watch them, and they're both doing really well. They're both making money. So, all right, let's go. And everybody wants more money. Everybody's not doing well enough. At some point you have to ask yourself, what is good enough? Where is my money? How much money am I making? Am I making enough money? How much is too much? How much is enough? I don't know. When you're getting ready to retire and you're working for retirement, do you feel comfortable retiring is a big question. Am I going to run out of money before I die? That's the biggest problem that we run into. So we're trying to make it so we have a residual source of income that continues without having to worry about whether you're going to run out of money when you die, because there's going to be a machine that sits there and runs for you and executes and runs and makes you money, and you'll never run out of money as long as the stock market keeps going. That's the whole thing, right? If we're going to depend on the stock market for our income, we got to have a good stock market. But so we got to also be able to make money when markets go down, because markets don't always just go up. And that's kind of what we're going to talk about today, is the market's getting to a point where I'm worried about it starting to go back down. And so that's why I titled the little marquee out front. I titled the little marquee is, how are we going to get back into the market? I've got a bunch of money sitting on the sidelines because I don't really want to put it in right now. And that was one of the reasons why, if you look at the SHI, is we've got rising interest rates. And so when the interest rates rise, it puts pressure on the stock market to go down. And of course, that's coming in coordination with what we talked about last week with the S&P 500 already reaching way up into the top regions. Now, in this class, and I mentioned this last time, I don't give trade recommendations. I don't come in and say, you should buy this one or you should buy that one. I see people doing that all the time. Buy this, buy that, apples, buy Apple, buy Amazon. I don't do that. Why don't I do that? Because I don't look at the market as oh, this is a buy signal, or this is what I do. I mean, you get buy signals and we point them out. You get sell signals and we point them out. But what I like to do is I look at the probabilities. Just like you're sitting at the blackjack table in Las Vegas. All right. When you sit at the blackjack table, it's not a buy sell always, situation. It's a, what are the probabilities that I'm going to make money on this hand, or what are the probabilities I'm going to make money on that hand, versus the market versus the, so you look at things in a different way. And if you think about the stock market, and I hate to think about the stock market as a casino. I mean, in certain situations, the stock market and a casino, when you kind of line those up and use them as comparisons, they work out. It works pretty well, because we want to work on probabilities, and that's what I do. I look at all the probabilities of the market rising or falling, and so I calculate what are the probabilities. Are the probabilities high that the market's going to continue to rise, or are the probabilities low that the market's going to continue to rise? And so when I give a trade recommendation, it doesn't come out as oh, you should buy this, or oh, you should buy that. I come in and I say the probabilities of this thing going higher pretty low. Do you want to take a low probability trade, or do you want to take a high probability trade? So I work through probabilities, and I created a system that works pretty well. It's my system. I created it, but it's not really my system. I created it based on things that have been around forever in the markets. Elliott waves and Fibonacci, and fundamentals of accumulation and distribution. Reverse engineering the BlackRock algorithm is really what we're trying to do, right? So I like to look at probabilities rather than, oh, buy this, buy that because of this or that. And no, it's what are the probabilities that this market's going to rise higher, or what are the probabilities this market's going to fall? And do you want to be getting into a low probability trade? And you can say, yes, I do. Why? Well, I may have some, extenuating circumstances that say that I still want to get into a low probability trade, because we work off of technical mathematical models, right? So again, going back to that idea of reverse engineering the BlackRock algorithm, or the big granddaddy of them all, Aladdin, to try and figure out where those guys are buying and selling, and where they accumulate them. Because the big money, what we call the smart money, right? They're constantly moving into the market and moving out of the market. And they don't ever just go in and say, oh, I'm going to buy this market, and suddenly the stock goes to the moon. Hey, we're going to buy, just slam into a big market. They don't do it like that. They go through what they call the accumulation distribution stages, right? So they'll accumulate over a period of time. And then to get out of a market, they don't just dump it. They distribute, or take their money off slowly over a period of time. That's what causes markets to make these fluctuating, snaky like moves, is the accumulation, and then the distribution, and then the accumulation, and then the distribution. And so these big firms, they move money into a market over a period of time, and then they move their money out of that market and into another market over a period of time. And it causes the market to have these little snaky moves. And so we try to count those snaky moves, because they like to work off of threes. All right. They like to move money in and out, take profits. And then, of course, you got the retail traders that are out there that screw everything up. All right. So they have all the emotion. So they jump in and out of markets. They buy. And then they sell. And, they're the ones who are causing all the grief and the screwing up the structure of the stock market, because they're emotional. And so, that's you and me. We get emotional about our trades. And so in this class, or in this, this, as most of you here already know, this is a class on, we're a lab for our university classes. And so I want to teach people the concepts, the deeper concepts of trading, not just run around and, be a stock picker. Yeah. That's fun to go and, look at our bubbles and see which markets are shooting up today for one reason or another. And, that's kind of a fun way to trade. But overall, it's not a sustainable method of trading that's going to allow you to have a consistent source of income so you don't run out of money when you die. And that's what we really want, right? We want a source of income that we can trust and believe in is going to be there for us. And if you understand the stock market from the way that these large institutions work, of moving money in and moving money out and accumulation and distribution, and you watch those waves of the market like the ocean moving in and out, when's the tide coming in, when's the tide coming out? It doesn't happen all at once. It happens over hours and hours, for the tide to come in. Well, the stock market's the same way. The tide comes in over months and months, a period of time, and then the tide goes out a little bit over months and months, a period of time. And so as you can work through those flows, you can find out where the probabilities are, where you're at in that motion of the ocean. All right. Motion of the ocean. That sounds good. That rhymes. And so that's what we really want to do. And so right now, if we look at the S&P, we're in the third motion of the ocean, right? We're in a nice big 3-drive pattern. And as I mentioned earlier, markets like to move in threes, all right? It's very common for them to move in threes because even though we're running and operating off of algorithms, right? Mathematical models and algorithms, those mathematical models and algorithms were programmed by humans. And so they take advantage of the human emotion and the retail traders. Now, remember, it's what I always say, those big institutions like BlackRock and Vanguard, State Street, and 10 others, they have all the money in the world. If you want to know who's running the world, or you want to know who controls the world, those guys, follow the money. Who owns the world? The people who own the money. The thing you have to remember, though, and everybody thinks, oh, well, then that means BlackRock is evil. Oh, that means Vanguard is evil, right? They, the root of all evil is money. I'm losing my voice. Hold on a second. I'll try not to forget to turn the microphone back on. All right. So money is not the root of all evil. The love of money is the root of all evil, right? Let's get the quote correct. So what we need to do is we need to realize that who owns BlackRock? I mean, if BlackRock has all the money in the whole world, who owns BlackRock? Because those are the people who are in control, right? Well, you and me, we own BlackRock. People own BlackRock. All of BlackRock's money is the retirement accounts, the savings accounts, the investment accounts of the people of the world. People primarily for BlackRock, Vanguard, and State Street, the people of America, right? The U.S. American economy is the savings accounts, the investment accounts, the retirement accounts of the American people. That's what it is. All right. So when they took us off of the gold standard, the dollar no longer is reliant upon the value of gold. It's now reliant on the value of the human labor force or the American economy. All right. That's what the US dollar is. It's backed by not gold anymore. They took it off the gold standard. So what is it backed by? Well, it's backed by you and me, our labor. What are we willing to go and pump gas for? What are we willing to go get an education for and go to work and become engineers for? How much money do you need to make to be able to go out and have a living, right? What are you willing to work for? That's what the US dollar is backed by. The US dollar is backed by the US economy. The US economy is backed by all the dollars that we've saved. And that's the motion of money moving through the washing machine of, what we call GDP, the savings, and BlackRock is the big machine or momentum of, and the other firms are the big machine of everybody in America who has savings and investments. So we own BlackRock. So when you hear that, BlackRock won a contract to rebuild, a war-torn country or something, name names, but we all know who we're talking about, right? So we go around and BlackRock gets to go in and gets this big contract, and everybody gets all bent out of shape. Oh, BlackRock, they're taking over the world. They're going out and, getting these big contracts. And, oh, we hate BlackRock. BlackRock's bad. BlackRock is you. BlackRock is me. BlackRock is, now maybe you're saying, well, I don't have any money in BlackRock. Okay, well, do you have any money in Vanguard? Do you have any money in State Street? Do you have any money in any of these big firms? Do you, any of these big banking institutions? Do you have any money in Chase? These are the big firms that America owns, these great big investment firms. You own them. So whenever, Donald Trump goes and negotiates a deal where BlackRock gets to come in and rebuild a country or gets a big contract, all he's doing is he's negotiating so that the American people are the ones who are benefiting from that, right? I mean, that's what's happening. We own BlackRock. We are BlackRock. The Americans, we're BlackRock. And so if BlackRock gets a big contract, well, if you're not happy about it, go put some money in BlackRock. Then when your money goes up in value, you're happy about it. It's all a state of mind. I mean, if you're not participating in the upside, maybe it's your own fault. Go participate in the upside. I don't know. But if you're mad, if you hate BlackRock, why do you hate BlackRock? That's just the American people's savings account and the people who are managing it, trying to grow that money for them. That's what they're doing. All right. You can hate BlackRock if you want to, but there's really no point. You just hate the savings accounts of the American people. And, if they win a big contract so that they can have produce jobs and economies and, we're just taking over. Okay. Well, welcome to the world. You know what? The United States, a big country. We dominate. We do a lot of things. Why do you think we're the biggest and the best? And you're, benefiting from that by having a life here. Livelihood is here. It's pretty good. You want to go to another country? A lot of people hate it here. Well, they can leave, but they won't. Why? Because it's great here. I don't know. I don't want to get into that side of the market, but that's what it's all about. So, are you going to hate BlackRock? Well, you're just hating the American people's savings account and the people who are managing it. Now, for us, back down to our little, ant size business, what we're trying to do is we're trying to figure out how BlackRock, what they do with that money. They move it in and out of different markets. And so we want to be able to do the same thing they do and reverse engineer it. Right. So I don't want to go into the whole accumulation distribution model right now, but that's basically what it's all structured around, right? That's why I take the chalk and money flow. And I used to have it set, and depending on the version of the software you have, I used to have it set so that it was, in my opinion, the right way. All right. Now, I've had a little argument with the computer programmers, which was right way, which is upside down, which is upside right. But I wanted it set so that when I owned the company, I wanted it set so that it was the accumulation distribution model. Well, they're like, well, we have to be like everybody else. And everybody else has it red this side, green side, this math board, that, whatever. Just give me my reverse formula then. So this works. This is my settings specifically for the chalk and money flow. So if you're, depending on the version of the software you have, it might be different than mine. But if you have the version of the software I have, these are the settings you want. You want reverse formula. I don't like to display the arrows. They mean nothing to me. And then I want the chalk and money flow period set to 12. And then I want the CMF minus is green and the CF plus is red. So you may need to change this around depending on the version of the software. If you have the older version of the software, just hit TNT defaults and it'll be like that. But they changed it so they want to be like everybody else. They don't want to be the way Lan wants it. They want it to be, part of the Borg. So everybody, this is the way everybody else does it. So we want to be like them. Okay, be like everybody else. That means I have to change mine because I don't want to be like everybody else. I want to be the way it makes sense, the way it's supposed to work, which is buy low, sell high. It's the accumulation distribution model. All right. So that's why it's green on the bottom. This is where you buy. When it's red on top, this is where you sell. So if you want to track the big money, the BlackRock, the Vanguards, the State Streets, then you want to go ahead and you want to buy low, accumulate shares when it's green. When markets are coming down, this is where you go through the accumulation stage. Now, these indicators and the big firms, they'll accumulate maybe a lot earlier than we want to. They got bigger pockets. We're smaller pockets. So we have to be a little bit more wise about our accumulation stages. We want to accumulate down in here. We want to buy at the, hindsight's 2020, and it's always easy to say, oh, well, I would have done there or I should have done there. Well, that's how you learn. You got to look back in the past. And past performance is not necessarily indicative of future results, but it's the best we got. So we look back in the past and we say, well, I would have been really smart to buy here. What did the indicators look like at that point? What did the market look like at that point? So this is how you reverse engineer the BlackRock models. This is how you reverse engineer, the big players. You look at what they've done in the past and what the markets look like, the patterns that they created. And then when you see that pattern happen again, you say, well, last time I saw this pattern, this market did this. This is what they did. This is how they moved their money in, and this is how they moved their money out. And so that has been kind of a long-winded way of saying, look at the past and look for those patterns, and that's going to give you your odds of whether the market's going to have a tendency to continue to rise or fall. Doesn't mean it's not going to. There's never any, oh, I'm 100% right. I know when to buy the market. Oh, I'm 100% right. I know when to sell the market. I've got my, my crystal ball here, and I can look in there for you, and I can tell you, whether you should buy or sell. So when you see these guys come out with newsletters that say, buy this, buy that, buy this, buy that, or they get on and start yelling and screaming, on their YouTube channels, buy this, buy that. Check and see why. Why are they saying to buy that? And look at the probabilities. You want to have a mathematical model laid over the top of your fundamental market. Okay, granted, we want to have fundamentals drive the long-term trends. We know that, but you also have to be able to look at when the right time to buy into a fundamental trend. Because if you're late to the fundamental trend, you can still lose money, even though the fundamentals are great. Oh, the great fundamentals. But at some point, the market, the waves move in, the waves move out. Oh, it's a great market. Sure, it's a great market, but the waves are moving out right now. So when I titled the thumbnail today, I was like, well, how do we know when the waves are moving out versus waves are moving in? Count them. Count and measure. Count, measure, set up, trigger, and follow through. Count, measure, set up, trigger, follow through. All right. So we want to count the waves. How many waves? Well, past experience tells us that the market likes to do 3 waves. Likes to have 3 major waves as the markets come in, and then it likes to have 2 little waves as the market goes back out before it makes 3 waves coming in. That would be an uptrend, right? If we had 3 waves up and only 2 waves down, well, you went up more than you went down, but you kind of more than anything, you kind of went sideways. But in the process of going sideways, you kind of went up, right? So it goes in and out and in and out and in and out, and a market makes waves up and down, but over the long haul, it's going up. That's called a bull market. That's why the markets go up. That's why you can hold on to your position, sit through those waves of the trend. And over a long period of time, the market should rally or go up more than it goes down. And it has. I mean, if you go back and look at the long-term trends of the S&P 500, over the last 30 years, the market has gone up. Okay, it's gone up and down and up and down and up and down because it's the ocean going in and out and in and out. But in the process, it goes up 3, it goes down 2, it goes up 3, it goes down 2, it goes up, down, just like that. And each one of those little waves or processes we call Darvas boxes, right? You've heard me say that before. Market goes up with its 3 waves, and then it goes down with 2 waves. And then when it starts going back up with its 3 waves again, boom, that 3 wave up, 2 wave down, that's one Darvas box, or what we call an Elliott wave. Okay, an Elliott wave is one 3-drive pattern with a 2-drive retracement. It's the 3 waves in, 2 waves out. 3 waves in, 2 waves out. Every 3 waves in and 2 waves out is one Darvas box. Okay. So we operate within what we call Darvas boxes, and we're looking for the accumulation distribution model. And why does this work? Well, it's because BlackRock and Vanguard and these big State Street companies, they create that process. Now, if everything was a perfect world and you and I and all the retail traders and all the, the emotional, psychological ding-dongs that trade the market weren't in there, well, the market would probably be even more predictable. Why? Because they're being driven by computer systems, and the computer systems are the ones that cause those, the waves in and out. But of course, then it wouldn't work, would it? The whole system would fall apart if we didn't have the emotional trader in here trying to, jump in and beat the market. We're the emotional side of it. And again, BlackRock, Vanguard, State Street, all those guys, they have all the money in the world. The only money they don't have is yours. What's in your pocket they don't have. They want it. All right, because they want to take it and give it and distribute it to their shareholders. It's how they make profits. So they can make profits in a number of ways. They can trade the market, take all the money that you put in there and try and make it yourself. So they take it from you and give it to their shareholders, which are just their clients, which are people who are just have their retirement investments in them, right? The American people, they're just taking money from one hand and giving it to the other. Take it from these poor schmucks who don't know how to trade and give it to the guys who just invested for the long haul, just waiting for the waves to happen over a 30-year period of time. And that's what Vanguard and State Street and BlackRock, they manage a lot of those types of funds, right? School teachers putting money in, firefighters putting money in, engineers putting money into their long-term savings account from work. That's what they manage. And then, of course, they can do other things, like they can win contracts to go out and, rebuild construction at this point, countries, right? Because they're big enough that they can rebuild countries. So they can get contracts like that. And of course, it's not like BlackRock has, BlackRock doesn't have tractors and road graders. They don't have mining equipment. They don't do that. They invest in companies that have that. So when BlackRock goes out and wins a contract, they're actually fronting or helping win that contract for these big firms that actually do that. These big American companies that build the world, make the world go around. So they go out and they front for that because they have their money invested in those companies. Then those companies get those contracts, and then BlackRock does well. It's all a big circle of life, right? All right. What about me, Lan? What about me? That's the big picture. I want to see the small picture. Well, let's go down and look at the S&P 500 right now, and that's what we're looking at right now. And you can see the probabilities. The probabilities of this market rising much higher before it gets a pullback is starting to dwindle. Does it mean it can't go higher? No, it certainly can. We're just looking at the odds. And we're looking at the odds and saying, well, in the past, BlackRock, Vanguard, State Street, they have driven the markets up. The wave system, 3 waves in, and then they'll go with 2 waves out before they start their 3 waves back in again. Well, this market here, the S&P, which is the backbone of the financial industry, right? The 500 biggest, best companies in the United States, or basically in the world, are already in their 3rd wave pattern. How do we know? Well, we have mathematical models that have in the past proven out to be able to track the BlackRock algorithm pretty darn well. And I call it the blue light system. You can get it with I've got it tuned in on the bulls and bears. Now I've got the bulls and bears turned off right now. So if we come into the bulls and bears, you can see that it's set the sensitivity setting to 72. So in your track and trade software, set your sensitivity setting to 72. Okay. And somebody just said, track and trade software? I'm new here, Lan. What's that?
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so we're using the stocks version right now, and if you go into the bulls and bears, you set the sensitivity 72. Now, for the formula, I like that to be progressive. There's a bunch of formulas in there, and in some classes, we'll go through and talk about some of these different formulas, but the one I like is progressive. That's my favorite. That's my number 1 favorite, progressive. All right, so sensitivity 72, progressive. For the most part, we're just using TNT defaults, but you do have to change the formula to progressive because the traditional, the TNT defaults come in at traditional. And I like progressive. I like to be a little bit more aggressive than just that one. All right. And then the colors are the red, yellow, and green. And then I turn this on, show blue light system. I think for the defaults, if you go TNT defaults, those are turned off. So they turn everything off, just the color codes. But we want this turned on. So you turn on those little blue lights. All right. And the little blue lights are what you're seeing laid over the top of the chart. Now, I'm trying to come in here, and this is what turns the price bars red, yellow, and green. And red, yellow, and green is all based on the Fibonacci. All right. So Fibonacci is the Fibonacci sweet spot. It's the neutral zone. So it's very important when we're doing Fibonacci work that we have the bulls and bears turned on. And you can try and do it without the bulls and bears. And that's what I try to show, because there's people who, some of you don't have the bulls and bears. You buy Track and Trade, the bulls and bears is a plugin you have to add in. You have to pay extra for it. Depending on how they're doing it. Right now, they've got some licenses that you just subscribe to the software and subscribe. You don't buy it, and then it comes along with it. So you get the bulls. I don't know how the structures works over there anymore. So I don't know whether they're leasing it to you, whether you buy it, whatever. It used to be that you have to buy it. You have to pay them extra money for it. So some people didn't have it. So what can you do? You can come in and you can use the parabolic SAR, and the parabolic SAR, you can set up so that the blue light is very similar to the blue light on the, your parabolic SAR. You can set up, and it's actually red, but I changed it to blue so it would be the same. And then you set your settings to a little bit different settings over here, 2020, 112, and then it makes it almost exactly the same as the bulls and bears, but then you don't have the color coding. So you don't have Fibonacci, you just have Elliott wave. All right. So the Elliott wave is the pattern, or the 3 drive patterns. And if you don't have the bulls and bears, you can reproduce it that way. But there's advantages to turning off the bulls and bears too, because then you get the reds and the greens in here, and the little reds kind of help you know where the market's going to break too. And so if you have your parabolic SAR set on, you're going to just, save as my default, update that. And then, then I have the Donchian channel turned on for Fibonacci. So, and you can draw your Fibonacci rulers too. And it's just a different way of looking at it. And it's kind of tools that help you read the chart better. But really what we're trying to do is we're just trying to identify those 3 drive patterns. And then of course the delta Kona probability. So the delta Kona probability is that the markets have a tendency to come back half or 50% of the last major move or minor move about 68.2% of the time. Okay, so let's just say 70%. 70% of the time markets come back to their 1 standard deviation. That's just a mathematical model that you can go and look up and learn about if you want, but basically that's what a Fibonacci ruler is. Fibonacci ruler just tells you the market has a tendency to reverse back to that 50% level, and that's called the 68, 95, 99.7 empirical data distribution rule. I renamed it because that's too hard to say. I just called it the delta Kona probability. All right. So we want to go and we want to do that. We want to be mindful of that. That's what bulls and bears indicator does. It helps you with that, with understanding and seeing where those color codes the market, so you can see those mathematical models. All right. If you don't have it, you don't have it, and that's okay too. You can just not use it. Use the parabolic SAR instead, and then just use the color codes to help you with the color codes of the market. Now I use, of course, Heikin-Ashi because I think the smoothing component helps us see the waves better. All right, and that's what we're trying to do, smooth it out so we can have a little bit better view of what BlackRock is doing with their money. And they're pushing money in, they're rolling money into the market, and then they roll the money out like the waves of the ocean. And so right now we're at the backbone of the financial markets. The S&P is all the way up to the top. I'm nervous that this is going to have a delta cone of probability. 68.2% of the time the market has a tendency to reverse and come back into the 1 standard deviation. And if we lay our 1 standard deviation tool over the top of the market, well, 1 standard deviation is all the way back down here. So are the waves going to get ready to start to move out? Is the tide starting to move back out? Right now it's still moving in. I mean, the tide's still coming in. But what are the probabilities? Again, I don't give you buy sell signals. I tell you what the probabilities are. So the probabilities that this market's going to go much higher is dwindling. It's getting lower and lower and lower. And right now, technically speaking, this came into what's a D1, which is really rare. We don't generally get D1s. We usually top out at the C drive, right? We get drive 1, drive 2, drive 3, or A drive, B drive, C drive. At the top of the C drive, C3 is what we call them, little 3 drives, C3. And the only reason I call this a D1 is because it broke the blue lights. But actually, when I get rid of this arrow, it did not break the blue lights. All right. So we need to, it's not a D1 right there. That it would be, that would actually be since this is a C, we only count the A drive to where the lights break. And then when the lights break right here, see these little blue lights, they broke. And then they broke right here. And I thought they were going to break right there, and they did not break. So that's not a D1. So that would be a first little break, little red bar. It'd be a C2. All right. C2, Lan. Type it. C2. So you get the A's, and usually inside of each drive, you get 3 drives. So that's called fractal, right? So you're Your A drive should have 3 little drives in it to be perfect. I mean, right out of the manual, right? We'd have the A drive. And then in the B drive, you'd have 3 little drives. And then in the C drive, you'd have 3 little drives. So bigger drives, you know, the whole wave system. And then you have 3 little waves inside of each one of the bigger waves. And that's just the probabilities. And that's just, you go back and look in past performance, and that's how it works. They just do that a lot. All right. You see it all the time. And a perfect setup would be 3, 3, 3 of your 3 long drives. So now what we're doing is we're coming in here. This is a C2, right? This would be the second drive. So we got a little bit of upside potential. We go to a C3 before this thing breaks and comes back down into the delta cone of probability. And that's the whole run. Now you can have little deltas, right? Little delta cones of probability. So you can come up here and you can find, and we'll measure just the one little deltas in here, little delta drives for each one of those drives. So, you know, it gets a little sophisticated in there, but just overall, we're just kind of looking for this type of a move in the market. And that's why I have the Donchian channel on here. It just tells you where that 50% retracement is of the current value of the market. So that's what we're really doing here with the Donchian channel. We're just being lazy. And really what we're doing is just being lazy and saying, well, you know, from the top to the bottom of that drive is that red line in there. And I've got my Donchian channel set up like that, so I don't have to keep drawing the Fibonacci ruler over it all the time. All right, so that's how that is. And then we just want to go look at different markets and see what the probabilities are that the market's going to start to fall. Now, right now, the probabilities are pretty high that we're going to get a retracement. Does it mean the market can't go up? No. I'm not telling you that what markets are going to do and what markets can and can't do, or which markets are going to go up, which ones. I'm telling you the probabilities. The probabilities are that we're reaching very high up into the market, and retracements are going to be more likely right now, right? Downtrends. The market hasn't stopped yet. It's still moving higher. Didn't break those blue lights yet. When it does, that'll be the top of the C drive. And then, you know, we usually get that A, B, C pulling back out, and we'll finish off with a 1 full Darvas box, right? 1 full Darvas box would be 3 drives up, 2 drives down. See, 2 drives down like that, A, B, C, just like this one. A from the top, A, B, C. And it made the 2 drives down. That was the end. And then it started back up again with 3 drives. That's just classic. It's right straight out of the manual. The manual, Ann? What manual? Did you write this down? I did. Of course I wrote it down. What do you think I am? Of course I wrote it down. Where's the manual? It's on Amazon. Go search Lan Turner on Amazon. You can get the manual. It shows you all this stuff. It's all written down for you. All right. Lan Turner on Amazon. Now let's go down and look at some of these different stocks we got money in. Now this market came down off the top, and the problem that I've got, we got 3 nice drives down on Apple, right? And then it went up and it started to do this, and then it died, because that's what Apple does, because Apple sucks. And we all know Apple's a rotten market, rotten stock. I'm going to stop being so mean to Apple. We got a long call right here because we thought maybe this market would break up on this. This is the breaking of the blue lights, right there. So this is a bullish position in the market. As it went sideways, it went through a basic accumulation stage, or actually it was a failure of an accumulation stage. You can see from the indicator right here, the market was supposed to rally and it failed. So it's got into a reaccumulation stage. So this is what the red's doing down here. It's telling us that the market is being bought up by the big players in anticipation of a rally. Now, Apple needs to rally hard. We got a long call and we're losing money. The market's going up. It's above our green line, but it's not going fast enough to outperform the time decay. Now, we also have a put option in here, or a call option that we sold. So we sold some premium up here and we collected $714. Right now, the time decay is only at $4.50. So if we liquidated, all we'd get is $4.50 out of it. But we're not going to liquidate it. We're going to hang on to it. And it expires in 24 days. So we kind of want this market to kind of be up here, like right there would be perfect. That would be max profit. And we'd have the profit from the rise in the market, which it's got to rise faster than time decay. And the market's going through a reaccumulation stage. So this whole thing was kind of a failure to rise with the rest of the market, because the rest of the market went up. Remember, we had a big, the market shot way up. S&P, everything shot way up. The only one that didn't, Apple. Why? Because Apple didn't recover, because it doesn't participate. It's a tech company, and they're not participating in the AI world. And we've talked about that. I'm not going to go into it again in this class, but they're not doing AI. And so nobody wants to buy their stock. All right. And I got a great video. I need to give you guys the link that you can go watch how Apple's been captured by China. Apple is actually a Chinese company now. They have their headquarters in the US, but they're a Chinese company. All right. So that's Apple. And that's all there is to say about Apple. We're in accumulation stage. We want to see it rally right here, go back up. We'd like to see it go fast because we have an option. If you buy an option, markets have to almost explode to make money because you're fighting time decay. And if time decay takes away money faster than the market's rising, you still lose money even though the market's going in the right direction. That's why you sell a call against it, collect the premium, because then if it doesn't go, at least you get the premium from the option that you sold against it. Advantages and disadvantages. We're not going to go into the whole detail of that. Let's go look at AMD. We made a bunch of money on AMD. We took our money off. Now look at the perfect pattern in here. This is your drive 1. This is drive 2. This is drive 3. Now, this is C1, so this is a pullback. That's C2. So the higher we get, now if it goes back and breaks the blue lights, then it'll be a C2 failure, and we'll be going back into we'll be looking for our little, pullback like this back into the Fibonacci sweet spot, right? Let go. So we'll be back down in this region here. This is what we'd like to see. Actually, we would like to see AMD do that. Why do you want to see AMD fall? Because we want to get back in. That was the title of the show today, right? Of the presentation. What we're doing, we're looking for the opportunity to get back in. Should you get in right here, Lan? Should we buy AMD right here? Well, can if you want. Is it a buy signal? Well, it is. I mean, if we'd get a green bar, first green candle to make a new high would be the C1 going into the C2 drive. But the probabilities of making much money in this are pretty low because you're already up to the top of the third drive. And if markets, the ocean likes to wave in on 3 drives in and then 2 drives back out, you're going to be fighting a pretty big ocean. And not only that, the backbone of the market, which is the S&P 500, right, which we talked about, the S&P 500, SPY, where did it go? There it is already at the 3 drive. It's just, why would you fight? It would be like trying to go up a down escalator, right? Very difficult to do. The market just, it's up at the top of the 3rd drive. Should I be buying into this market right now? You can if you want. Is it a buy signal? C2, it is a buy signal. C2 is a buy signal. Is it a good buy signal? No. It's a very low probability of success. Doesn't mean you can't do it. Go on to Kramer. He'll tell you to buy it right now. Buy. Oh my God, it's doing great. Hong Kong. And he hits all the buttons. He's so excited he can't stand it. He's banging on the sleeve. Oh, and he's got the CEOs on the market. Buy. Oh, everything's so exciting. Just look at the probabilities. What probabilities is that? Is that good probability to you? Do you want to take that trade? I don't. It's breaking new highs, Lan. It's coming across. It's breaking new highs. Everybody wants to buy when markets are breaking new highs. Buy. I don't. Not me. I'm biting my fingernails. I don't want to buy right there. That's the top of the 3rd drive. I know it's breaking previous highs. I know the market's making all-time new highs. I know people like to buy all-time new highs. I'm chewing on my fingernails. I don't want to buy right there. It's the top of a C drive. The probabilities, the Delta Kona probability says that I got a 68.2% chance that market's not going up. I don't want to buy with only a 30% chance the market's going to rise and a 70% chance it's going to fall. But I want to be in the market. I want to be, oh no, what about the excitement of everybody's making so much money? I can't lose. Look at this. The market's gone straight up for the last 3 months and I'm just rich beyond my wildest dreams. I can't miss out on this. The odds say don't buy. The odds say don't buy. Does it mean it's not going to turn and go into a 4th drive? No, we've talked about that too. Last time it went up, It went 4 drives. Drive 1, drive 2, drive 3, and then it went drive 4. So right there was the top of the drive 3. That's where I got out. I missed this drive. And then it went sideways, and I was out. I wasn't in. But I also missed this. I didn't get caught in that. And then when it came down here, well, I'm at the bottom of the second drive. I started to load up. I put a lot of money in the market here. I rode it all the way up here. I rode it all the way up. I got the second drive. I added more. I loaded all the way up. It's third drive. I started to take some profits off up in here, but I still had some, still got some. But now I'm pretty much clear out. I got just a little bit of money in there. I haven't got completely out, but I got a little bit of money in there left over from this big long run, not adding new money. Where are you going to add new money, Lan? Well, where would you add new money? Knowing that this is the top of a third drive and then we got the waves coming in, and then we got the 2 waves going out, I would wait for the market to come back down here. Now, if you know how to make money when markets fall, you might want to put on some positions to make some money in this downtrend that I think is coming. I think we'll get a blow off. I think we're going to get a little bit of a pullback. We may not. I mean, think back last time we were in the Trump train. Donald Trump was president. Market never pulled back, never gave us that opportunity. It just kept going and going and going and going and going. Past performance is not necessarily indicative of future results, but it's the best we got. And that guy makes markets go up. Well, we know because he did it before. And he said he was going to make it go up. He did. Now, it went down a little bit after he said that, but it was kind of crazy, right? Went through the accumulation stage. But that's where we're at. We're at the top of the third drive. And I don't, I'm always one to believe that BlackRock controls it more than the president of the United States. I don't think the president of the United States, but he drives his policies drive the overall longer term economy, whether, it's by borrowing money and putting it in like Biden did, driving the market up, or whether it's bringing money in from outside countries and investments back into the GDP, whichever way you grow it, whether you borrow it and put it on a credit card, which Trump did too, right? I mean, we just raised the debt ceiling $4 trillion, which is why Elon's all pissed off, right? Didn't want that to happen, but they raised the debt ceiling another $4 trillion. So they just borrowed more money on the credit card. Now, of course, they haven't taken it all off on the credit card yet. They haven't gone right up to 4 trillion. I mean, they're on their way. They'll get there. Don't worry about it. Next year, they'll be fighting over a new debt ceiling again. But all that money will go into the economy. Plus, you got all the money coming in from all the deals that he's been doing. So is it going to pull back? I think it will. Why? Because BlackRock wants to digest what they've made their money, and they want to get in. They want the market to fall so that they can get you guys to give them all their money, jump out of the market, scare, and then they can buy up all your shares, and then the market will rise once again. So that's Apple. All right. And AMD. AMD's way up here to the top of the third drive. Go up there. It looks like a C2 to me. Do I want to buy AMD up there? I want to own AMD. I want it really bad. Yeah, I want some AMD. Am I going to buy it on a C2? No. Probabilities tell me that it's a real low chance that I'm going to make much money off of it before it turns and falls back down. Is it going to turn and fall back down? I don't know. Past performance says that it will. Past performance not necessarily indicative of future results. Do you want to buy right there? Buy the dips, right? You've heard that. Buy the dips. Does that look like a dip to you? I think a dip's coming. That's what I'm trying to tell you. If we go down through every single one of these, now look at this one. We bought a call right here. This was drive one, counter trend, drive 2. We got into the B1, right? And then this thing flushed all the way back down, and it's making this little trough down in here, and it broke this. That becomes what? If this is B1, that pulls all the way back to this point here. Well, it hasn't broke the blue lights on the retracement. Technically speaking, it's a B2. No, I mean that would be C1. That would be C1. And we bought the is that right? No. Yeah, it broke the blue light. So this, we have to count it properly. So that's X1S. So this would be X2 right here. So yeah, it is into C1 drive. Okay, so that's the CX2. So it broke the blue lights and it's coming down. And this would be, if it would go rally and break the blue lights back to the backside, that would be a C1. But it's coming way back already, clear back down into the Fibonacci sweet spot from that first two drives. If it breaks the blue lights, it looks like to me it wants to break the blue lights on the downside. We went long right here in anticipation of a break up and out of here. But look at this nasty little thing that happened today. Look at that. That's not good. And this pattern right here, this little rolling thing, this is starting to look to me like an ABC to the downside. This looks like A, B, C, D. It wants to come down farther, maybe down to 61.8. If it breaks those blue lights, which is the little mathematical trend line, right? So we got our natural trend line, we got our mathematical trend line, which is almost on top of each other, and then you got your horizontal trend line. So that's your spider web. If it breaks those blue lights, well, I'm going to take this call option off. Just take our lumps, because that thing's probably going to flush all the way down to the 61.8 level. That's the probabilities. Is it going to do it? I don't know. Just telling you what the probabilities are. Probabilities are we're going to see this thing if it breaks those blue lights. If that thing can't hang up above that blue, it's going to come all the way down here. And that's not good for our long call. So that's why we're down. All right. Again, look at this one. This is the problem we had, is this rebound here was so big. Usually we'll get, that'll be your 3 drives like that. And then we get the little thing like this, right? But this was all one big drive. It was so big that becomes A drive, B drive. This is the scary thing for me right now. Are we going to get a C drive up in here? Or was this too long? It's got to digest that as 2 drives. Because normally speaking, each drive is about a month long, right? In these markets. If you look from high to low, you can see that things move in 1 month periods. You can see those vertical lines. They're kind of hard to see on over the internet, but there's vertical lines in there. And each one of these drive systems are about 1 month long, right? And they don't necessarily have to start and stop on the beginning and ending of the months, but it's funny how oftentimes they do. 1 month will be the rally, and it'll kind of, and then the next month will be the pullback. It goes through month waves, and that's just a rule of thumb. It's not something you can rely on every time. But when you look in history, you can see from 1 month to the next that each one of the months was kind of where these patterns come out. So you get your down patterns and your up patterns. But we're in for another couple months of down patterns. That's all I'm saying. That's all I'm saying. I don't want to be a buyer up there. So where am I going to be a buyer? Well, I'll be a buyer when these markets give me a pullback. But what if they never give you a pullback, Lan? What if they go on to the 4th drive and the 5th drive and the 6th drive without you? Well, that's what they'll do. They'll go without me. I'm not completely out. I just don't have a lot of risk on. I got a very small risk on right up in here. And I'm going to show you something else. All right. So there's Bristol Myers, always been a pain in my side. So we're waiting for this one to give us, it's got higher lows. It's not exploding higher. Why is it not exploding higher? Well, it could be a couple reasons. First of all, it might be going through an accumulation stage, which is where the big boys are buying, right? The big boys are buying, picking up shares so that they can explode this thing and make all the money when the market starts to rally and start to sell out to you guys, us guys, I need to include myself, right? When we buy up the uptrend, somebody's got to be selling to us, and it's going to be the big boys who bought down here. They bought a whole bunch. They accumulated, right? Accumulation stage. So they're accumulating in here. That's what it looks like to me. And when this market starts to go, they're going to decide. We can't decide for them. They're going to have to make up some reason why they want the market to go, and then you'll hear some news report that comes out that tells you how great Bristol Myers is, and then you'll start to buy into Bristol Myers because it's got some great news for it, and then they'll start selling all their positions to you as you retail traders. We retail traders start to buy into the rally. So that's what we're waiting for. We're waiting for the big banks, BlackRock's, to decide that they've got enough Bristol Myers, and then they'll send out a news release that says everything's great. You should buy Bristol Myers, because they've accumulated all the shares they want and they want to sell them to you to make money. That's how they make money. Salesforce going through the same thing. It looks like another accumulation stage. All right. This is how the big boys make money. They accumulate a long dead market, and then they send out a news release that says it's time to buy this one. This is a great market. You'll probably hear it on Kramer. Kramer will tell you to buy. Okay. So you just listen to Kramer. He'll let you know when it's time to start buying Salesforce, because that means that the big banks have accumulated as many shares as they needed, all the shares they wanted, so that they need to sell their shares now so they can make money. That's how they make money, is they sell out, right, while you buy in. So you just listen to Kramer. He'll tell you it'll be time to buy CRM. You wait and see. Wait and see. Mark my words. Happens all the time. All right. Cisco. Drive 1, counter trend. Drive 2, counter trend. Are we going to go into a nice, big, long, strong drive 3? I don't know, but it is a drive 3, and that's a C1 right there. C1. Do you want to buy at the top of a C1? Do you trust that market's going to make a real nice, big, long C1 drive? C drive. The last drive, right? We just measured the first drive. Drive 1 was this big. Drive 2 was this big. Well, if we say, well, it could drive 3 could be that big, we would anticipate a Fibonacci projection. We have a little tool that does this for us. We go here, 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 and then that projects where we think that market's going to go. 100% would be the same distance as the B drive. Right in here would be up to 100%. So that would be your first target. 130.9 is your golden ratio. So if the market went up to 130.9, that's where it'd go before it turned and started to come back down again. And that would be your little Fibonacci bow tie, right? From this point to this point, up to 100. Let's just go to 100, down to here, and then back to your Fibonacci bow tie right there. All right, so that's the pattern that you would look for if you're going to buy in on that C1. I love Cisco, Lan. I love it. I love it. Oh, it's just been going up and up and up and up. And I want to buy the dip, buy the dip. Okay, well, realize that if you buy the dip, you're buying the C1 dip, the third drive. Okay, doesn't mean you shouldn't. No, C drive can make you some money. Go ahead, buy a few shares. See if you can't ride it up. Make a little bit of money on it. It's going to be tough because it's petering out. All right, you want to buy a market that's petering out? Or do you want to wait? Keep your powder dry. Wait for it to go up there. Create that C up there. We don't know where it's going to be. Up there somewhere. And then if it comes and makes a little ABC back down into here, it'd be easier to buy down in here. But if you bought up in here and you didn't sell and take your profits right there, then you'd ride your losses all the way down to here. And then you'd feel bad and you'd yell at Lan. Lan told me to buy up there at the top of the C1, said I could make money. Oh my gosh, Lan's the most terrible guy in the world because he told me to buy a C1. Yeah, I'm also telling you, if you buy at a C1, you better damn well be ready to sell out at the C2 or the C3. All right, don't hang on to it as it comes all the way back down into the Fibonacci sweet spot. This is where I'm going to buy. I'll start putting limit orders in here. I'll oftentimes put a limit order on a strong market, maybe at 38.2. Take a little bit in here, 10% or so of what I want to put into the market. And then I'm going to put 20, a little bit more at 50. Man, I'll load up at 61.8. I'll back the truck up. That's where I like the market to come back down to. I want to be buying down here. Now, it might come down. If it comes down and we start buying in, we'll have to realize that it may go through an accumulation stage. That's oftentimes what happens. Markets go through the accumulation stage right in here. We might get a nice rally and a pullback and then a sideways market, right? Which is exactly what's happened here. Going through a sideways market, accumulation, AMD. So we expect to come down, go through accumulation. App, gone up, coming down, go through accumulation. Choppy, choppy, choppy. Now come up, pull back down, go through accumulation, and then they'll run it again. Bristol Myers going through an accumulation stage. I think they'll run it. CRM going through an accumulation stage. Watch, I think they're going to run it. This is one we could start putting money in. Salesforce, good company, right? And so Big money likes to go into this thing. Choppy, 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 and they'll run it. This is charm 1, charm 2, charm 3. Probably getting ready to run it. Cisco. I'm going to wait for them to come back down. Would you like to have some Cisco? Yeah, I'd love some Cisco. I'd love me some Cisco. All right. Let's wait till it comes back down into the accumulation stage so that we can accumulate some. Carvana. I want some Carvana so bad. I want to be in on this market. This market's doing really well. You go look at the fundamentals of this market. It's killing it. Drive 1, drive 2, drive 3. Is that really drive 3, or are we not going to, or we're going to discount this one right here, this little ABC? This ends up being drive 1, just like the other markets. Counter trend, drive 2. It's breaking here. It's that drive 2 wasn't very big. I don't think we're going to get a big drive 2. I think we're going to get a retracement here. Are we going to? I don't know. It's at the top of the C drive. According to the way we measured this out in the first time. I mean, that one big long drive right there is, again, a little bit scary to me. You know, it should be a 2-drive pattern based on the months, right? I think Carvana is going to be pulling back. I want to buy it down here, buy some 10% in here, buy some 20, buy 60, 70, 80% in here, or buy, get up to 50% of your money in here, pick up a little bit more at 50% on its way back up. So you pick it up on the way down, and then you pick some more up on the way up. That's how you do it. You come down here and you do the accumulation just like the big banks do. You can do it with smaller sizes, obviously, but we're going to pick some up as it comes into the dip. We'll pick a little bit more up as it comes into the dip a little farther. We'll pick a little bit more up in the dip as it comes down farther. Do you have your full amount in at 68.8, or you got 100% of everything you want into the market there? No, because you got target zones here as the market starts to rally again that you can put some more back in. So if you got 50% in here, you can add another 20%, 25% in here, another 25% in here. You get 75% in of the full amount you want in. Let's say you want $100,000 in this market. By the time you get all the way down and then turn around and comes back up, you might have your 75% in. You can have it in here. And if it gives you another couple of dips, it gives you an opportunity to reaccumulate a little bit more. And then by the time this thing breaks and starts to run, you got a pretty sizable, accumulation of shares. I can't draw today. My hands getting wiggly, getting shaky. So we come down in here and there we go. And that's what we want to, that's where I want to buy Carvana. What if it doesn't come down there, Lan? Then I miss out. And that sucks. I hate it when I miss out. But sometimes you miss out because it doesn't come into the market and doesn't give you what you want. So you miss out. Well, you suck. You're a bad trader then. No, you're not. It didn't give you the setup you're looking for. If it doesn't give me the setup I'm looking for, I don't know how to make money. I'm not smart enough to make money on a market that doesn't give me the dip. I need the dip. That's the only way I know how to make money. I don't know how to make money any other way. So, but Lan, why don't you go into CVNY? And then you just want to CVNY, and then you can just have, well, if I was to go into this market, I'd go into CVNY. I wouldn't actually I might on Carvana, I might buy some underlying shares or some options or something. I'd trade Carvana, but I'd like to have some money in CVNY, and I don't have any in there yet. Why not, Lan? You could be missing out on all the dividends that this market would be paying. Well, because I'm worried that I would get my dividends and then I'd just give it back to them in net asset value loss. So if the market just keeps coming down, I just be compounding my losses. So it doesn't really do me any good. What's the point? Right? You're just treading water. And I treaded water a lot through that last big downtrend. I kept held on to a bunch of my and just tread water. And there's nothing wrong with that. I mean, you get more shares, you get more shares, you get more shares, but then the shares their values way up here. So by the time it just takes longer to get your money back. There's no reason to jump in. If you think the market's going to come down, you got a pretty good idea. I'd rather just wait and not tread water. I'd rather just wait. That's just me. That's why I put it out there. Wait. Because I would rather wait for the market to come back down in here rather than get my money in here and say, well, I'll just, take the big dividends all the way down. Well, then you're just using your dividends to cover your losses. And that's okay. I mean, you're not losing any money, or you're losing less probably. But Wouldn't it be more fun if you just waited and stayed out and didn't use all those dividends just to cover your losses? And then when it come down here, have all that money piled up that's saved. You're getting your dividends, you're not putting them back in. Wait till the market comes down here and then strategically put them back in. That's why I always say don't drip. Because if a market's falling and you're dripping in, all you're doing is, you're treading water. You're trying to walk up a down escalator. It's hard. So I would rather just wait until it comes down here. It's like trading options, right? You could sell a call option way up there or sell a put, right? We could come in here and we could sell a put on Carvana. Think about this for a second. You could sell a put on Carvana right here. Let's come down here and let's go out. I don't know, 24 days. We'll just look and see. I'll bet you there's an option. Oh, geez. I thought there would be better options on this market. Okay, let's say we're going to sell an option down here. Okay, you can sell your option right there. And what are you going to collect? $382 if the volume, depending on the volume. I don't know if you can do anything like that. You might be able to pull something off in here, right? So, okay, you're going to get $293. But what is an at the money option valued at? If we sell a call, sell a put at the money, that's $2,705. Well, if you waited for this market to come down, which you think it's going to do, right? Now, if you don't think it's going to come down there, you could sell an option and collect $293. There's nothing wrong with that. I'm just saying that if you wait for this market to come down and you sell your option down here, you're going to get $2,750 instead of $293. I would much rather have $2,750, and all I have to do is wait. I just wait for the market to come down there a little bit closer to where I think it's going to turn around and start to go back up, right? And I sell my option at that point. Now I'm going to get $2,750, and I didn't have to sit through the big drawdown of this thing going negative on me and freaking out and go, oh no, it's going negative. Right? I may lose my $293. Oh no. I'm having a lot of sweat over that. Now, if it comes all the way down here, you can sell it at the same spot. And if it gets filled, so what? You get your $2,750 and you get your shares at the price you wanted. So it's better to wait. Just sit here and wait for that market to come to where you want it to, and then put your option in there. Sell your option. And then if it starts to rally, which is more likely, right? It's come down here, start to rally, you're more likely to keep your $2,750 and not have to worry about that $293. You're sitting there freaking out over your $293. Well, don't put it in right now. But then you might miss it, Lan. Okay. You are right. Might not get your $293. Do what you want. Just telling you the odds and the different options you got. I like to wait. For me, I would rather wait. I'll sit here and wait for that to come down, and then I'll sell an option for $2,740 down here rather than $293 up there. I can do both. Okay, do both. That's great. Great idea. Just remember, you got to have the margins to do it. And if you get filled, you got to have $100. You have enough money to buy the shares, $34,000. You do both? Do both. If you can afford it. If you can't afford it, don't do both. Which one would you do? Well, I'd rather do the $2,745. But then you might miss out on the $293. Okay, I might miss out. That's the name of the game. All right. So now we come down here. This is the Carvana. This is probably the one I'd put my money into if this thing would fall far enough for me. If this thing comes back down into this Fibonacci sweet spot down in here, I'd probably start trading it if I could. I don't know. It depends on the volume. Look how rotten the volume is here. Let's see calls. Yeah, they're rotten. I can't believe that the volume on Carvana is so rotten. That's really disappointing. So I'd probably just put my money into CAVNY. This is where I'll be putting my money, but I'm going to wait. I'm going to wait for it to come down here. So I'm not just covering my losses because I believe it's going to fall. What if it doesn't fall, Lan? Then I miss my opportunity. I don't get it. That's sad for me, right? Sad for you. We don't get it. Here's Delta. Delta went through a reaccumulation stage. Drive one and reaccumulation. They sit there and chop. This is charm one, charm two. It looks like to me it wants to break back down. The problem is you got a stock that wants to rally. I think Delta wants to go. I think it wants to break out. I think it wants to make a nice, big, long 3-drive pattern. I think it wants to go. Why isn't it going? Because the S&P 500 is losing all the momentum for the whole market. Because the S&P 500 and the SHI is going up. That's putting pressure on these markets that want to run. I think Delta wants to run. I think that the big speculators, the big hedge funds have bought a bunch of Delta and they want that market to go. But they got pressure to keep the market down. They got SHIs going up. You got interest rates are going up. And you got S&P 500, which I can never find. There it is. SP 500 is pressure to not go up. And look how tiny the little bars are. It's not going. It's losing its momentum. So Kim says she has a lot of money in PLTR. So let's jump down there and show something that you guys are interested in. Let's go look at PLTR. I got a bunch of money in this one too. And I actually had a bunch of money in the actual stock itself, PLTY, or PLTR, in PLTR. I don't anymore because it got up in here into where the probabilities of this thing falling back down, and I took my profits. I've still got a bunch in PLTY, right? I didn't take those off. But PLTY, that's a whole different story. We don't look at that one. It's a different story. PLTR. Now, if we look at PLTR, look at this. This is nice. That's bullish. We didn't get that's a X3 right there. I mean, this is so ugly. It almost, we got drive 1. To call that drive 2, I want to call this whole thing drive 2. This is a counter trend. Looks like we're going into drive 3. This whole little mess up right in here, where everything just got all jumbled. I think that was a reaccumulation. I think what happened is the big boys come in here and started accumulating. And you know how they accumulate? We've talked about this before. They buy 100, they sell 90. They buy 100, sell 90, buy 100, sell 90, buy 100, sell 90, right? So the market chops up, chops down, chops up, chops down, chops up, chops down. At the end of the accumulation stage, they've actually got a whole bunch of shares because they buy more than they sell, but they don't let the market run. That's how they do it. That's how they accumulate a whole bunch of shares without driving the market higher. It's called the accumulation stage. That's the process that they use. Now there's not a guy sitting there clicking the mouse button, right? It's a computerized system. They just turn it on and say, we want to accumulate a bunch of shares. They hit a button and turn on a mathematical model that sits there and works it out. Throughout the next month, it'll just sit there and accumulate a whole bunch of shares, all mathematically modeled. That's why the market chops all over the place. Now, can it not do that? Yeah, of course. I mean, you got maybe Vanguard wants to run the market and BlackRock doesn't. But that's not usually how it works. Those guys are all coordinated. And because they're all running Aladdin, they're all running the same mathematical model. They all incestuous. It's like the Borg. So they're all accumulating at the same time. It's why the market does what it does. So it's why, you go through the accumulation. Then this thing ran a little bit, pulled back down. I think we may be going through an accumulation. We may get in a whole new drive right here. It didn't pull back like we wanted, or not yet anyway. We may have to wait a little bit farther for it. They want to run it a little bit more. I don't know. All I can tell you is the odds. The odds are that we're getting really high up in here I want to call this a C drive. I just want to call that C drive right there. We don't have it. This is C2 right here. I want to call this C1 right here. Get out of the way. Got so many tools on the screen I can't draw. So I want to call that C1. This whole thing right here, I think is a new reaccumulation. So let's get rid of some of these things. Get rid of all these arrows. I think we're just going to call this right here B1. I'm going to just call this B2. And I think that in hindsight, that's a little cleaner, right? I think that's a little bit better idea of what's going on. So that little dip right there. So I think I'm going to rename this. Sometimes it's easier to read on the fly. Sometimes it's harder to read on the fly. It's easier to see in hindsight, right? I think that's just one big drive right there. I think that's a reaccumulation stage where they took it through here for a little ways and then pop and then go again. We're going to get a nice C drive out of it. I don't know. You want to be a buyer right there? I certainly don't. I don't want to be a buyer right there. Do you want Palantir? I want it really bad. I've got a bunch of Palantir, again, in PLTY. I don't have any PLTR. And I would like some PLTR because this thing's a nice growth stock. You make more money in PLTR if you can catch it at the right time. I'm going to have to wait. But Lan, what if it never comes down there? What if it just keeps going up, 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 up? Well, then my PLTY will be doing just fine, and I'm not too worried about it. I'm just trying to decide whether I want some PLTR. And I don't want any PLTR right now. I don't. It's the odds of me making money on PLTR right now really low. The odds are bad. The odds are bad. Bad odds for me. All right. How do you guys feel about, you guys got any stocks you want to go look at? You got any specific stocks in your portfolio that you're like, Lan, go do this one. Lan, go do that one. There's shop. We got to wait. You know, it's all the waiting game. Here's one. Well, that's here. We don't want to buy that one. Okay. SMCI. I was about ready to say, buy this one. Look, it's in a buy mode. It's not the one we want to be buying. We don't want this one to go up. We want this one to go down. SMCI. Look, this one here. Super micro computer. Ooh, I would like some super micro. I would love me some super micro. Where are you going to buy super micro, Lan? Well, if it doesn't dip, I'm not going to buy it. I don't buy if I don't get a dip. I've done that. I played that game. I'm done playing that game. If I can't buy it at my specified point, I don't buy it anymore. I've lost too much money buying too early and just sitting through a big old drawdown. I hate big drawdowns, especially with options, because you just don't ever recover. Is that going to be the top? I don't know. Is this we called this the X3S A1. So we called that A1 first drive. We called this B1. So that means it could break that and go into the C drive, right? If it comes all the way back down into here, and remember the S&P, you always got to keep that in the back of your mind. The S&P is at the very top, tippy top. It's going to have pressure to pull back down. And what pulls the S&P down? Well, the failure of all these other companies that are at 3 drives getting ready to pull back. Toast. There's one that went through the accumulation stage and just broke out, trying to go higher. Charm 1, charm 2, and it broke out on charm 2. You think we'll get a third charm? Do you think it'll pull back down and give us a charm 3? I don't know. It's already rallied here. 1, 2, 3, 4 nice rally bars. Remember, usually we get 4 nice rally bars and we get a red bar. And then you get the first green candle to make a new high, get back into toast, and away you go. Sell an option, Lan. Sell an option. Wait for it to pull back. Wait for it to pull back. If it pulls back a little bit, just a little bit, 2 red bars would be nice. And then get what, those 2 red bars. I don't know if you can sell option. I don't know if this thing's got any volume on the options. Let's go see if we can sell a put option in here. You don't want to sell it today. Let's go 24 days. Man, look how rotten the volume is. It's just sad. Nobody trades options anymore, especially during the summertime. It's summertime's doldrums. Just be mindful of that. We're trying to trade in a hard time of the year to trade. Just kind of sit on your hands a little bit. There's nothing wrong with that. If it's not the perfect, absolute perfect setup in the summertime, you don't want to take it. There's Tesla. Tesla just broke the blue lights. So let's look for a couple bar pullback and then another rally. I think Tesla's, I'm really frustrated with the fundamentals of Tesla. And the fundamentals meaning Elon Musk is giving people heartache with this market. They're selling cars faster than they can make them. So they should be able to, they're making money and they got all kinds of great products coming out. They got robots, they got everything. Everything's going. So, the future looks bright for Tesla if Elon Musk would stop being a politician. Daggone politicians. That's TSLA, TSLY. They're just kind of hanging out, not doing anything. The dividends kind of sucked. This whole dead market, all because Elon decided he wanted to be a politician. Maslow's hierarchy of needs, right? Maslow's hierarchy of needs. Ali, which one? Analyze daily, and you will see you have a triangle. Which market? Palantir? Were you talking about Palantir? You thinking that one's going up? I think you're talking about Palantir, right? So let's go back to Palantir. He says, look, there's a triangle in there. PLTR. Look on a daily chart. This is the daily chart. You say, look on the daily chart, and you will see a triangle. The triangles come in between these locations here. This is where you're going to find your triangles, right in here. Right here, right here. These are your triangles. The pennants come in these little things right here. This is where you're going to find your pennants. The little A2s and A3s. Those are pennants, all right? So those are your little, if I could draw. Those are your little pennant formations. There's another little, this is a kind of a breakout right here, but this little pennant formation comes in right here. That's where you get your pennants. The triangles are these bigger moves right in here. See that? It's a triangle right there. This is a triangle right here. What's the difference between a triangle and a pennant, Lan? Well, pennants are the little short stubby ones. The triangles are the longer ones. So you get support across the bottom and resistance across the top. And generally speaking, in an Elliott wave pattern like this, I'll draw it real. What's wrong with you? Turn off that auto scale. So we get a 3-drive pattern like this, right? Okay, that's a standard Elliott wave, or one Darvas box. So what happens is you have the smaller ones are come in here like this. I'm not going to draw every single one going up this whole thing, but you get the point. You get another little 3-drive pattern here, another little 3-drive pattern here, and another little 3-drive pattern coming down here. All right, so this is kind of the patterns that you're getting. So this is what we call the A drive right here. This is the B drive, and this is the C drive. But inside of here, you get an A1, which is the starting of the first drive. You get this little break in here. That's the B2, and this little break in here. That's the B3, right? Then you get the little ABC coming down, and then we start our C drive here. So this ends up being, this is where you get triangles right in here. These are triangles. You're going to get another one right here. Now, I oftentimes will do these with, let's draw that back in there, man. So that's your triangles. Okay, that's where you get triangles. These are pennants right here. They're little triangles, but they're not triangles. We call them pennants because they're smaller. So we generally, traditionally speaking, you'll get a little triangle in here. Oftentimes a little pennant in there, but it's usually not tradable. So you get these little triangles here. So let's take this one off since it's not tradable. And then this is where I come in with a spider web, right? I call it a spider web, but it's actually your natural trend line, your mathematical trend line, which is going to be your blue light or your parabolic SAR. And then this is where you're going to get your horizontal trend line. So that's the breaking of the previous high. So this is where you end up with your Fibonacci bow tie, right? You take this high right here, which is a very important number. You take this low down here, you go up to this high, back down to this low, and that's usually, right, testing this previous high. So that's why you get this pattern. All right, that rallies up, back down. That's your bow tie. So then you end up with another one right here. So you end up with another bow tie right here. All right, so that's your Fibonacci bow tie. So you get the break above the previous high. This is your. Now, is it always this perfect? No, this is like what you're going to see in the manual. You're going to get the natural trend line, the mathematical breaking of the trend line, and your horizontal breaking of the trend line, like that. So that's the kind of the general patterns that we get as markets move through price and time, the 3-drive pattern. And then you find these little patterns in here. It's just kind of the way that you work to predict where markets are going to be and where your setups and your triggers and where your count, measure, setup, trigger, and follow through, right? What are you counting? Counting the waves. You measure, what are you measuring? The distance of the rallies and the pullbacks. You're looking for the little, different patterns. And of course, there's other little patterns in here too. Like, for example, this is where you're going to get your head and shoulders formation. A lot of people familiar with head and shoulders formation. Well, that's where you're going to get your head and shoulders formation. You get the high, your left shoulder, your right shoulder, the natural trend line, right, which is what we call the neckline. And then, of course, you can draw your natural trend line all the way up through the whole thing like that. And as long as it stays above the natural full line, we call well, 3 little mountains is what we've been calling them, right? We just make it easier for people to understand. We get 3 little mountains. So you get mountain 1, you get mountain 2, right? And then you get mountain 3. And that brings you to the top of the 3-drive pattern up your progressive trend line. And then that's where you get the break. And then you get a Fibonacci ruler. Now you measure Fibonacci from top to bottom like this. And then you measure the entire thing from here to here. That ends up being your Fibonacci ruler, and then that brings you back into the Fibonacci sweet spot, goes through the accumulation stage. We start the whole process all over again. All right. So is that what you were talking about, Ali? So if we come down here and we take this model and we come back down here, there's your little triangle. Yeah, this is kind of ugly right here with Palantir because we got this little reaccumulation stage right in here. I think that's what all that was. I think they didn't. We expected. I think they wanted the market to fall a little bit further, and it didn't do it. So they had to go through the accumulation stage. We're just getting another wave pattern coming in. How far? I don't know, but it's up there pretty high. To me, that's a C drive. I'm going to call that a C1, and I don't really want to be a big buyer up in there. I want to see more of a pullback. We may not get a big pullback because it's just such a strong stock and everybody loves it, right? So you got your first little drive there. If you just go off of this one, there's 3 little patterns. There's your little mountains, right? 3 little patterns like that. I don't know. Are we going to get a break? Is it going to hold and go one more? Or is it going to break and come down here and test that 50% level right there, that Fibonacci number? Right back down in here. I'm not going to be a buyer unless it does. That's all I'm saying. The odds are that that's not a great place to buy. Does it mean it can't go higher up in there, go way up in here, and then land feels bad? No, of course it can. I'm just not going to buy there. I don't care. I'm not buying there. I'm going to wait till it comes down here. If it doesn't come down there, I'm not going to buy it. That's me. You can do what you want. I'm not telling you what to do. I'm telling you what the odds are. The odds are that's not a good odd. That's a lousy odds. Because you play blackjack and you have and you've got a 7 sitting on the table. It's pretty lousy odds, right? A 3 sitting on the table, a 2 sitting on it. It's not a very good odds. Does it mean you can't win the hand? Nope. You can still win the hand. You can still win the hand with a 3 sitting on the table. You can still win the hand. I don't generally like to call it, I was talking about this earlier, I don't generally like to call the stock market a casino. I'd rather call it a carnival game. At least in a carnival game, you can get good at it, right? You can pick your tent, you can go up to it and you say, I know the odds are against me, but if I practice long enough and hard enough on this tent, I can beat those guys, even though the odds are against me. They've made the basketball hoop a little bit smaller and they put it farther away and they give me a little tiny ball or a bigger ball. I don't know. They do things to make it so that the odds are against you. But if you practice and you're good at it and you practice at that tent, you can win and you can get the big panda. That's why I like to think of the stock market as a carnival game rather than a casino. Because the casino, every single time you step up to the table, your odds are the same. Now everybody's like, oh, well, no, we got 10 blacks in a row. That means I got to have a red. No, it doesn't. It doesn't mean that at all. That's the fallacy. That's what they want you to believe. That's not the case. The odds are exactly the same every time they roll that dice. You're going to lose every single time. How do you think they build those big buildings? They don't build them because they give away a lot of money to winners who sit and wait for 10 blacks and then they get the red. Nope. The odds are exactly the same every single time you roll that dice. There's no skill involved. It's all has to do with luck. And I don't believe the stock market is completely filled with luck. I think the stock market, you can beat it if you have skill. I think it's more like a carnival game. The odds are always stacked against your favor, and you know that. We all know that the odds are against us. Every single time we go into the stock market, the fact is the odds are against us and we can lose money. But if we do it right, if we stand there at that tent and we figure out that we can throw this little tiny ball into that little tiny hoop that's further away than all the rest of them, we can eventually get good at doing it and we can make money. So I know that for me to make money at this tent, this PLTR tent on the fairway of the carnival game, I know I only want to buy when I'm down here. If I buy up here, the odds are against me to make money. I'm probably not going to make money up there. Does it mean you can't? No, certainly can. You might hit a basket or two up there, but the odds are so bad. I don't want to take those odds. I wait till the odds are better in my favor. And for me, I've made a lot more money doing it that way. All right. There's plug. Nice little trend line, nice little mountains, right? Is that a second little mountain? Are we going into a third mountain? It looks like it. I'd like to have some plug. That looks like a good market. They're getting ready to rally. But I don't want to buy up there. Let's wait till it comes down here. And then that would be the third. I would like to see it break that. And then I can start buying down in here for the next rally up. Is that what's going to happen? I don't know. If it doesn't, I won't buy into it. All right. Let's go. I wanted to show you something else before we cut you loose. This is the new calculator. And the only people who know about this calculator is if you come to this class. And since the class has been going for quite a while, and we still got a good group. I'm surprised how many people are still here after this long. A lot of pontificating going on. So those of you who are still here, here's your reward for being here. Here's the calculator. Go to pitnews.com/dividend-calculator. I've updated the calculator. So the calculator, if we come in here and we go to the investment calculator, I got 3 of them in here, 3 different calculators, right? And I've updated the dividend calculator. Remember we talked about this last time we used the dividend calculator. I said, wouldn't it be nice if we could put 2 in there and it would compare them? Well, we did it. We got it done. Thank you, Grok. Grok did this for us. I went in and spent the day. You have to still work with Grok. You can't just say, Grok, go do it. Well, you can, but it took me all afternoon to get Grok to do this. So it still took a little programming. You still have to kind of work with Grok. But nonetheless, Grok was able to give us a comparison between stock 1 and stock 2. And we come in here and we can now put 2 in there and you can hit compare. So you can go play with that. I'm not going to do it right now in the interest of time because it's just something I want to show you we got done in there. So the dividend calculator now has 2 and you can compare. pitnews.com/dividend-calculator. All right. So we're going to come over to that's the break-even calculator. I'm not going to play with that one. I'm going to go to the investment calculator. Now, the investment calculator has 2 questions in here. How much income can I earn and how much do I need to invest? We're just going to do the how much income can I earn. And I'm going to come in here. I'm going to put down $10,000. So if I invest $10,000, how much income can I earn? Hit calculate. And it's going to give you the list. And this is current. Grok updated it for us. So it's now all updated. And we also added in the Where is it? Oh, it was still there. We added in the Granite shares. Here they are. So remember the Granite shares? We were talking about Granite shares, and here they are. So Granite shares, and these are puts. All right. They make money with puts instead of covered calls. They're covered puts is what they really are. Okay. So come back over here to our calculator, and you can see I put them in there with a little asterisk. All right. See that? So the rest of them are still yield max funds, but the ones with little asterisks, these are the put options being done by Granite. Okay, there. See, little, I think that's all of them. So these two right here, this is the S&P 500. That's where it fits in. It's giving you about a 49% return. And this is the QQQ, which is giving you 49% return. That's pretty damn cool. So what this is telling you is if you put your money in there, if it maintains this standard, you're going to get your money back in 2 years. You'll give you 100% of your return. You'll have a 100% return in 2 years. So you'll be a cash cow in 2 years. Everything after that is you're on the gravy train, right? So we'll have TQQ, SPY. Those are neat. I like them. They're done with put options. All right. Now remember, just because they're giving you these returns and stuff, you still want to be smart about it. You still want to go into the SPY and realize that, do you want to be putting money into the SPY right now? Right? What do we talk about? No, the odds are not very good that the market's going to continue higher. Does it mean it can't? No, it certainly can. Am I? No, not going to. I'm not going to, because the odds are bad that the market's going to continue to rise. Could it continue to rise? Yes, it certainly could. It goes back to that thing. Are you going to put money into it, Lan? No, I'm not. Why? Because it's not giving me my setup. My setup means it has to come back down into the Fibonacci sweet spot. That's where I get in. Are you going to lose money if it goes and takes off and goes to the moon? Well, of course, I will lose the money that I could have made had I got in on a really bad hand. I could have got in on a 2 or a 3 in my hand at the blackjack table and made money because I would have won the table. But I would have won it's bad odds. So I probably wouldn't have bet much anyway. Maybe one chip, right? So I'm only sacrificing the profit I'd make with one chip because I'm not going to put very much in there. If anything at all, I'm not going to put anything. I'm going to wait until it comes down. Well, what if it doesn't come down and you have to wait till it comes down here? What if it never comes down, Lan? It'll never come back down. Okay. That's okay too, I guess. I've got money in the markets, and if it never comes down, I'll still make money. I'll be okay. I'm just not gonna make more money. I need it to come down. That's all there is. I need it to come down. So that's SPY. So are you going to go and put a whole bunch of money into YSPY? If the SPY is way high? No. Well, but Lan, it gives you 50% return. That's past performance. That's past performance. I want to wait till it gets up. Now, both of these yield max funds and the Granite funds are designed to make money when the market rises because they're selling puts. And if the market falls, well, puts don't make money if the market falls. The market makes money. Sold puts make money when the market goes up. Right? So the market needs to go up. So if you go put your money in there right now, YSPY, and thinking I'm going to get a 49% return, and then the market falls because you're a C2 drive, probabilities are not good that it's going to continue to rise. You're not going to make your 49% over there on the puts. You're going to have a drawdown. You're going to be compounding your losses, right? We don't want to do that. So wait, be strategic. Be strategic. That's all I want. Just try. You don't have to be perfect. Like Lan, I need to put exactly how much money in on exactly when the price hits this exact perfect date. No, you don't have to be exact and perfect. You just have to be better than good, right? It's a little bit better than bad. Just don't be bad. Just be a little bit better than bad. Okay, so this is bad. And if you wait and it comes down here and you get in here, well, that's better than bad. But if it comes down here, you're like, well, I got in here. Well, it's still better than bad. And then you just, right? You miss this little bit right here instead of this whole thing here. So you don't have to be perfect at it, and you don't have to put everything in all at once. You can get in a little bit here, a little bit there, a little bit here, a little bit there, a little bit here, a little bit there. We don't ever go to the blackjack table and go all in. Sometimes you do, and you make a big bet of money. You put all the odds in your favor, right? There's times that you might want to put a big chunk of money in, but generally think about the waves. It's the ocean. You get waves, or they come in, they come in, they come in. So if you miss the first little wave and you're like, oh damn, I missed the first little wave, well, don't freak out. It'll probably make another little wave, right? So you might miss just a little piece of the first wave, but that's okay. When it waves back, you can catch the next wave. That's what the Fibonacci bow tie is all about, is catching those waves. So here's the one that I wanted to show. Look at this. This is craziness. That is really crazy and cool. TSYY, right? The YMAX TSLY is clear down here now because it's been having real struggles, right? So what this is telling us, where in the hell is TSLY? Look at that. This is the yield max version of Tesla. That's a covered call, which hasn't been doing well because the market's been dead, right? Covered calls make money because when the market rises, they get the profit from the rising market. Plus, they get the premium, what we call the consolation prize from the sold call, right? When the market falls, you get the sold call, but you lose money on the drop. Well, if the market's going dead, like Tesla is, TSLY, TSLA, it's just dead. Well, covered calls don't make money in this. Now they do, they make money. But if you saw, I'm going to show you. I'll pull up my real money spreadsheet. We always like to go see the real money. I'm sorry that I'm not keeping up to date on the, I'm too busy keeping up my real money spreadsheet. I haven't time to keep updating the demo account, but that's okay. The reason I send you the demo account version is so that you can have it and create it, make your own spreadsheet out of it, right? You get that when you subscribe to Pitt News Mag. You get this spreadsheet when you subscribe to Pitt News Magazine. But you can see Tesla. Look at this. The July Tesla. Well, I can't complain about that. Of course, I added some in. But I got $5,170 in July for my Tesla, so I can't complain about that. That's good. Last month was $4,600. $7,900 in May, which freaking good, right? Man, live. That was killer. And then $5,300 in April, and then March was $3,000. But this is when the market was coming down. So it was coming down. This is just sideways. It just went sideways. It still gave me $5,000. Can't complain about that. Which one am I waiting for? Waiting for YBit. I don't get YBit until the 27th, and then I'll have my July will be filled out completely. Right now, I'm sitting at 25,000 for the month. This has been a slow month, a summer month. What do you expect, right? But actually, this is estimated to be $6,000. So if I get $6,000, that'll put me up around 31,000 again. So June was 31,000. I'm expecting I should be over 30,000 this month. I got 53,000 in May. This is real money. This is not a demo account. This is my real money spreadsheet. So I'm at 25,000 right now. And I have YMAG, YMAX, Misty, Snowy, Tesla, YBit, Palantir, NVIDIA, and MRNY. I'm not saying this is not a recommendation that you should go buy these. I got into these a long time ago. And so I want to roll some of this money out. I want to actually get out of these. So if you're looking at this saying, "Oh, Lan's in this one, I'm going to go get in this one," don't do that, because I got in these. So I got into these, most of these, clear back in July of last year, almost a year ago, and I want to roll them out. I want to get into some of the better ones, but I got to do it strategically. I can't just suddenly take all my money out of one and put it in another. That's not. I want to do it strategically, right? It might take me a while to get my money out and in. And now the new one I added was MRNY. And I got an article coming out in Pitt News Magazine about MRNY, so mRNA. So you're going to be interested. You're going to want to see Pitt News Magazine, the July issue. It's really good. I'm happy about it. It features me. Claire got a little crazy. She She wanted to do a piece on me. So there, it's it's a piece on. There's a piece in on me in Pit News Magazine this month. I don't really like it because it's about me, and I don't really like things to be about me. But she wanted to do it, so it's in there. All right, so that's where we're at with MRNY. So my first, how much money have I got in there? I got $28,000 in there. Yeah, I got 28,000. Is that what I got? Total infusion. Yeah, current value. So, oh, I had a loss from when I did it in 2024. So I'm starting a little bit behind because I only put these two in. See that 7778. I put in 10,000 here, so I put 17,000. So I got 16,700. I put like 17,000 in there, and for my 17,000, I got my first dividend, and it was $1,392. You know what I need is I need another column on here that tells me the return for just that line item, the percent return for just that line item. So I'm going to work on that this afternoon. Now you know what I'll be doing today. I'll be adding a new column to our spreadsheet. But I think I got it down here. Don't I have it down here? I don't. I used to. I took it out. My goodness sakes. Okay, I'm going to put it up here. I want to know just the percent increase, the percent value. It tells me right there 51%, but that's historical. That's not real. And it probably won't be much different than that. It'll probably be very similar to that. But I want to see. So I'm going to put another column. All right, so that's my spreadsheet. I'm up 25,000, waiting for my final one to come in, which looks like it should be around 6,000. So I should be up around $30,000 again this month on this one account. I got my traditional IRA. I got this little account finally to the point where I can show it. So you can see I got YMAG, Misty, Tesla, and this is real money again too. And on this account, I'm at $9,000 this month. So if you add those two together, 30 plus 9, I'm at 39,000, pushing $40,000. And then of course I've got my Roth, I got my SEP, and I got my HSA, I got Janice's accounts, but they're not ready to show because they're still on the old spreadsheet. So they're still on this spreadsheet. I haven't got them all moved over yet. It's a lot of work. And so I apologize to you because every time I update my spreadsheet, I update the one on Pit News. And then if you want to keep current and you want that new spreadsheet, then you have to copy all your stuff into the new spreadsheet, or you have to take the look and see what changes I made and see if you want to adapt it to your spreadsheet. I know. We're working on the software program. It's really close, so you don't have to have a spreadsheet, but we got to have a spreadsheet for now until the software's ready. All right, Chad wants to look at, before we hang up the telephone, Chad wants to go look at Bitcoin. Which Bitcoin symbol do you want to look at, Chad? Because when I look at Bitcoin, I do it in the futures market. What's the Bitcoin in the stock market, the ETFs? We can go over and let's go over here and find a few of them because there's several. Let's come to this and we'll go back out to this and we'll go down to this and we can see the Bitcoin ETFs. Where are they? Where are they hiding? They're in here somewhere. Or do I need to go? Let's make this full screen. Full screen. I don't want that one. There's an expanded one. I don't want that. Real estate, utilities, energy. Where's the Bitcoin ETFs? Oh, wait, we got to go to ETFs. 1 day's performance, crypto. Well, there's crypto. BTC, that's the big one. There it is. All right, is that what you want to look at? Oh, you want to look at BITO. Kurt wants BITO. BTC. Well, oh no, this is just crypto. So I think you're right, Kurt. BITO is the one. I wanted to see him on here. Full. Where's the Bitcoin. It shows us all the ETFs for Bitcoin. Oh, well, we'll go look at BITO. BITO. All right. BITO. I don't know what this is really going to tell you. If you want to invest in this, I mean, we bought a bunch of options, right? And we made 100% return. We took off half of them, and then it flushed, and I just took the rest off. I'm not in BITO anymore. We had a bunch of options in here. I'm not in BITO anymore. What am I in? For me, I'm using the thing is, for when I've got too much into Bitcoin because I'm in all of these, not in Bitcoin directly. I used to be. I had a whole bunch. I just took all of my profits when it started to dive, and I put it elsewhere. So Misty is actually Bitcoin for me. That's my Bitcoin. So I have a bunch of money and Ybit. So I had coin, and I got rid of that one. And felt bad about it, but I rolled it into Palantir, so I don't feel too bad about it. But coin took off and went to the moon. So we've got, let's see, I got Misty and I've got Ybit. And those are the way I'm investing in this market right here. So MSTY. But see, it's not really MSTY. That's just the MST. Is it MSTR, right, Mr.? There it is. All right, so MSTR, we put a call option on this thing right here, and it's dipping right now. How much? We got 59 days left. Well, that's MSTR. And so if you have Misty, this is what you're looking at. They got some good news, and a lot of this is driven by the politics that are going on right now. And they're fighting over it in Congress on whether they're going to pass a bill that lets Trump create his Bitcoin policies. Where's the thing I'm looking for? Oh, there it is. Oh, no, I was looking for, where's track and trade? There it is. All right, so the other one, that MSTR is MST Misty over in the Yield Max funds. That's where you're getting your dividends off this thing. And I got a bunch of this stuff. So BITO, well, you can see that we have our 3 drives down. Drive 1, counter trend. Drive 2, counter trend. Drive 3. It broke that previous low, so that was the bottom of the drive 3. So that makes this an X3SA1, right? X3SA1. And so this was our first rally. This makes this a 2 right in here. And then it broke. So now it came down. Put your Fibonacci ruler in there. And that thing came all the way back down to our buy zone, which is right in here. Did you buy a bunch down in here? Okay. And then Lan won't buy it if it's not in the buy zone. The buy zone is that between 38.2 and 61.8. So there's your buy zone. And then starts to rally. Now we're getting a little triangle formation, right? Or a little pennant. There's a pennant. Let's draw it the right way, Lan. Pennant. So there's your pennant. So it should break out the top of that, right? And go one more time. So that would be, if that's B, this would be a B1 right here, or B2. So that would put us in here. This would be B1. Our first B drive is the breaking of the blue lights. And this is coming into a B2. So do you want to buy there? Yeah, that wouldn't be a bad place to buy. You want to be adding on. I mean, your original place to buy would be right down in here, right? Right here you'd have bought, right here you'd have bought, maybe right in here you'd have bought. So you'd been buying right in here. This is the accumulation stage. So the market came down and went through a little accumulation down in here. kind of choppied around. Little tiny head and shoulders formation in there. Just like that. Right in there. Give you a little head and shoulders. Broke the trend line right there, the natural trend line, which would just be kind of our little spider web thing in there. But that's your little head and shoulders on the bottom side down in there. That's just a perfect, beautiful little setup right in there, isn't it? And then it took off and out it goes. It's getting ready to break again, in my opinion. I think we're going to see it rally. That's a B2. We got the blue lights down in here. As long as it stays above the natural trend line, mathematical trend line, of course, is the blue lights. Where that intercepts, that's where we'll see it going into the C drive. So that's what we're looking at there on BITO. It's breaking above the previous high right now. They're testing that previous high off of this little triangle, this little wedge pattern. Kirk's right. That's right. BITO does have a pretty good dividend, doesn't it? So let's go look at the BITO dividend, because Kirk reminded me that it does have a good dividend. I sold out a bunch of my, and I held on to it for the dividend for a while. That's right. I remember that. How come I can't find my sheet? Oh, it's right here. Let's go look at BITO right here. So what's the dividend? You know what? We should have Grok. It's 77 cents on a 22. That's a good dividend. Let's let's use our new calculator. So we've got BITO, BITO, and it's trading at 22.84, and it's given us a 0.777. And let's go over to the Bitcoin version. So let's go back over here. And it's BITO, right? BITO. Isn't it? Isn't that what I said? I have to go look at my spreadsheet. No, not BITO. BITO's the one we're looking at. It's YBIT. YBIT. So we're going to see the BITO versus the one I've got, which is YBIT. So let's go back over to here and go look up YBIT. So YBIT is trading at $11 and 1 penny, and the dividend it's getting is 38 cents, 0.38. So let's go over to our calculator. Oh, look at this. We got to go to our dividend calculator, and we're going to put in on the first one, we're going to put in BITO, and its share price is 22.84. And our dividend amount is 0.777, and it pays out monthly. Both these pay out monthly, right? And then YBIT, and the share price is 11.01, and the dividend is 0.38, and it pays monthly. And we're going to put in $10,000 in both of them and calculate and compare. All right, let's see if our little calculator works. First time I've used it other than out of the test mode. Okay, BITO versus YBIT. So weekly, we're at 78.51. Annual, BITO gives us 40%. YBIT gives us 41%. So weekly, 78, 79. They're almost exactly the same. So monthly, 345, 340, 5 years, 20, 20. They're almost identical. YBIT gives us a penny more. That's it. Than BITO. The question is, would you rather be in YBIT or BITO? YBIT. So YBIT is the dividend version. So it's the yield max dividend version. It's going to give you, you know what? We might be better off being in BITO. You know why? Because BITO They give you the dividends, but it seems that BITO grows a little bit better than YBIT. I'm not sure how BITO gives their dividends. Do they do a covered call? Because this is not a yield max product. Do we know how they give their dividends? If I knew, I forgot. I'm sure I knew at one point. I would imagine it's a covered call strategy. Let's go find out. How can you find out, Lan? Very easy. We just pull up this little thing right here called AI system. What is the strategy that BITO stock symbol BITO uses to pay out their dividends? Is it a covered call strategy? BITO. Understanding the strategy. Additional notes. Sometimes the summary is just all you need. Oh, well, related. Where's the summary? Oh, well, okay. Start at the top, Lan. The ProShares Bitcoin Strategy ETF BITO pays a substantial monthly dividend, boosting yields that have reached as high as 40%, annualized in recent months. BITO generates these dividends not by writing covered calls, but by investing primarily in Bitcoin futures contracts rather than holding the actual Bitcoin. Earnings incomes from the roll yield in the futures market, especially during periods of contango, where futures prices sit above the spot price. Holding short-term U.S. Treasury securities to generate additional yield. That's their stabilizer. Engaging in swap trades to sustain monthly payouts. You know what? If that's how they're doing it, we may be better off in BITO than in YBIT. And you know why? Because YBIT, BITO, the way they're doing it would maintain the NAV, net asset value of the underlying, better than YBIT. You might be getting the same dividend as YBIT, but you're not sacrificing the NAV. You might be getting a better NAV on BITO than what we're getting on YBIT. Let's go look. We can look. Compare and contrast. Maybe. Come on. There we go. All right. So we're looking at BITO versus SPY. We want to see BITO versus YBIT. So YBIT is which one? YBIT is the yellow one. BITO is the blue one. You are right. Kurt, we would be better off having our money in BITO. I had it in BITO and took it out and put it in YBIT. That was a mistake. We would be better off having our money in BITO, getting the same dividend, but our NAV is not depleted. Our NAV is better. We're getting better NAV in BITO by $3.55. We'd be up $3 more in BITO during the same time frame. Look at this. Let's say we got into both of them at the same time right here. Over that period of time, we got the same dividend return, but the BITO NAV is much better. Wow! That's interesting to see. It looks like we're going to have to roll out of YBIT. That's a good question. That's a good question. We know the YBIT fees are $1 or 1%. Let's ask what the fees are over here for BITO. What are the dividend BITO fees? $0.95, so 0.5 cent difference. So they're about the same. In fact, BITO's even less, Kurt. So your expense ratio on BITO is less than it is on YBIT. YBIT just all around is a better vehicle to be in if you want to invest in Bitcoin. BITO is way better. We need to get out of YBIT and into BITO if that's what we want to do, if we want to maintain this position. If we're going to maintain it for a longer period of time, then that would be a better move for us. Because I think we're going to have better upside potential on BITO. If we believe that Bitcoin's going to rise in price, this is the one we'd want to be in. Now, of course, we could do the same. We could go do the same types of calculations on the others as well, but that's beyond the scope of what we want to do right now. It'd take us the rest of the afternoon to sit here and find all of these. Where in the heck is it? And how come I can't find them in here? That's not what I want. ETFs. Yeah, that's what I want. Where is our Bitcoin? There it is, down there. Is that? That's, yeah, there we go. There's BITO. So IBIT is actually bigger than BITO. So we could go look at IBIT. So can we just click on that? IBIT. So if we do IBIT, no dividends, good growth. Okay, so that right there shows us that BITO is depressing the NAV to pay out. But of course, that makes sense. Why they would have to? How else are they going to take the profits? They have to depress the NAV. They take the NAV out to get the profit. So IBIT's going to outperform BITO on the NAV, but they're not going to give you a dividend. So you're not taking profits along the way. But it looks like to me the process that BITO is doing over YBIT is better than the YBIT version. So the YieldMax version is not as good as the BITO version. So much good information here today. All right. There we go. There you go. All right, that's all I got for you today. That was some good information, Kurt. Thanks for the prompt, I guess, to prompt us in looking in that direction. And let's come over here and just for fun, we'll play with some of our little assets here. We got to listen to this guy. Do we want to listen to this guy?
Yeah, of course. I have a lot of subscriptions for magazines. My most recent subscription, I picked up a lifetime subscription to Pit News magazine as an example, among others as well.
Yeah, of course.
Yeah, when I heard Elon talking about Pit News magazine, I called in and got a lifetime subscription, myself, of course.
We would never use AI to give us celebrity endorsements. Never.
Look, folks, I was reading this thing, Pit News, right? Great stuff. I mean, back in Scranton, we had newspapers, but they didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
It's so funny. I've seen these things a million times. They still make me laugh every time. Every time they still make me laugh.
Hey, Lan Turner here. I got a hot stock market tip for you. Subscribe to Pit News magazine. You can thank me later.
All right, guys. I guess we'll let you go. One more. We got to do this one. This is my favorite.
Look, if you haven't subscribed to Pit News magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
You must have something wrong with your brain. All right, guys. That's all I got for you. We will catch you guys tomorrow afternoon where we're going to automate Paul Golden's system. And we're going to do a little bit of auto trading in the futures market for Power Hour. So Power Hour is at 1 o'clock tomorrow afternoon, Mountain Standard Time. Make the switch for your time zone. We'll see you tomorrow. We're going to automate the Paul Golden strategy. We're going to do Scalp and trail. That's what it is. All right. So we'll see you then. See you tomorrow afternoon. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.